Welcome back. On today's video, we're talking about buying a home versus investing in the market. I was looking at an article the other day, and this is from CNBC Make It, and they showed the S&P 500 on this graph has outperformed the home price growth in the United States for nearly 40 years. And when you look at the numbers, these are staggering. The S&P 500, it shows, made a 2,218% return. Dang. The S&P 500 total return, and the difference between the total and the S&P 500 is if you take all of the dividends that are paid out by the S&P 500 stocks and reinvest those into the market, it made a whopping 5,006% return over nearly 40 years. We're just shy of what, 36 years, 38 years, something like that. Well, the average home price, and this is the Case-Shiller U.S. National Home Price Index, so the index of all homes in the United States, returned only 374%. If you take that in a vacuum without any context, it looks like it is a no-brainer to rent versus buy. Do not buy a home, because why would you if you're making these kind of returns? The problem is this is not the whole story. Now, let me hit pause here real quick and say, if you are looking at investing, you should be doing, in my opinion, both. Buy a home if you can, but invest in the market. However, as far as this goes, if you are only looking at the return, this is how you can look at it. And this is a spreadsheet that I put together to bake in all of these numbers. If you were to buy a home in 1988, the average home price was $138,300. If you were to buy that home, most people do not buy cash. They don't pay cash for the home. They put 5% down or 3% down, or if you're buying an investment property, 20 to 25% down. And you would put, so in that instance, $6,900 down. Again, looking apples to apples, if you were to take that $6,915 and invest it in both the just return and the total return, this is how the numbers shake out since 1988. Using a 374% return, you would get a 374% return on that entire amount that you invested, less, and we'll go over the payments you would have made over that, but you're getting that return on this amount even though you only put 5% down. So that 370% or 374% return, because of margin, turns into $385,000. Again, because you're getting that full return on this amount here. If you were to take the $6,915 and get a 2,218% return, that equates to $153,000. And if you were to put it in the total return, not touch those dividends, it turns into $346,000. A great amount of money. However, you still would have made more had you put it into real estate, again, because of leverage. Now, real estate is the only type of entity that I would put leverage onto because of the way that real estate works in the United States. It generally, over time, will go up. The market, of course, does as well, but it is a more secure asset. Again, my opinion. Now, you may say, well, gee, if you're going to have that, if you're going to buy a home, you have a mortgage payment, and you're absolutely right. So what I've done is I've taken the average home price, the average interest rate from 1988, and I've baked that into it. But remember, you're still also paying rent. So with an apples to apple comparison, here's what you have to look at. Let me expand these two. So back in 1988, the average interest rate was 10.38%. And I'm just assuming that someone kept that 10.38% return, did not refinance it. Maybe they did have to refinance it once down the road because this is almost a 40-year term, and after 30 years, generally your mortgage would be paid off. But assuming you had $13,000 a year in payments, your net return is $44,000. So not great for almost 40 years, only having $44,000. That's why you've got to keep investing every single month. But then the other aspect is I went back and I had Google Gemini do a search for me on the average rents over that same time frame. And it pulled this list together from a number of different sources, from Apartment Guide, Rent.com, Realtor.com, Zillow, iProperty Management, and here's what it came up with. In 1988, the average rent, and I had to do research on a 2-bedroom apartment, was $550. Over time, this is the scale of the rental increases going down to 2025, when the average rent is currently $1,876. Now, based on the information, this one is from Zillow, but the prior ones are from Realtor.com. Rent actually ticked down -1% here. You can see in 2002 it ticked down. It says 21%. I don't know if that's actually 100% accurate, but again, these are the trends. There was the dot-com bubble that burst about here. In this time frame right here, you were looking at the downturn due to the great financial crisis, and that can translate to why we see a 19% decline supposedly in 2013. But at the end of the day, if you were to pay rent during that entire time frame, you would have paid $464,000 in rent, which is why you can see this return here going negative. So even though statistically the S&P 500 has generated a substantially greater return, the reason that you're seeing a 374% return end up being actually a better investment model is because you're locking in your cost. You fix your cost at a certain point. Yes, there's maintenance. Yes, there's all the other details, but you're not seeing 20% rent increases. The only increases that you're going to see when you buy your house on a fixed rate mortgage is your taxes will go up and your insurance will most likely go up at least some of the time. Your rent, unfortunately, is going to be locked in. So in the model of buy versus rent, my advice is always, if you can buy, buy. If you can afford it. Don't strap yourself, don't leverage yourself, because then you get into trouble about not being able to afford your mortgage and you're always going to have those maintenance costs. However, you do lock in your housing costs. I hope this has been helpful to you. We'll do more comparisons as we go forward, but in this particular scenario, looking back since 1988, apples to apples, it does appear that buying was the smarter alternative to renting. Now, I'm going to reiterate this again. Make sure you're investing every single month, regardless of your home situation. You want to be having that money going into the market, working for you, because that's the only way you'll build long-term rent. But if you're able to fix your housing costs and not have to worry about it going up 5, 10, 15%, as we've seen in some markets on an annual basis, you have a much greater opportunity to build your wealth. I hope this has been helpful. If it has, please give us a like down below. If you'd like to see more videos like this, do consider subscribing to the channel. And if you know someone this may benefit, do consider sharing. Thanks for being here. We'll see you on the next one.